Hi there, my name is Jamal Khan. I'm the head of tax at Churchill Tax Advisers. Today we are talking about inheritance tax planning. This is mainly for landlords and families who are high net worth. It's a very interesting topic, especially for people who have done well in their life, and then they start to worry about what will happen with their wealth or their estate or the properties once they pass on or once they die. Unfortunately, the rule of this country is that when you die, you have to pay tax. When you're alive, you pay tax, and when you die, you pay tax. So all your life you're paying tax, and after death you have to pay more tax. In fact, when you die, you pay 40% tax, unless you do tax planning, of course. So we thought we'll cover inheritance tax principles and how important it is for the elder generation or the children to talk to their parents what implications inheritance tax can have on families, which I come across very regularly. Unfortunately, part of my job is to deal with probate matters, or once the people have passed away and they don't know what to do, or the children who come to see me, they don't know what to do, and I have to break the bad news to them that now 40% of the estate of your parents that they've left for you has to be paid in taxes. So I'm dealing with quite a few cases, and it's very sad to see such cases unless some tax planning is done in advance. So very basic principles first. Inheritance tax is paid at the rate of 40% or above the nil rate band. So the nil rate band is 325,000 per person. And it can, if you have a property which main residence, which is above this value, it can go up to £500,000 if you have a main residence that you live in. £500,000 per person, and hence we can go up. This is being increased from this to this gradually, and it will get to that level hopefully in a year or 2 years' time. But between husband and wife, say up to £650,000, or if the value of the main residence is quite high, up to £1 million between husband and wife, which is £500,000 each. So anything in excess of that is taxable at 40%, unless it qualifies for some reliefs. Now, we'll look at a few assets. First is, for example, if parents are sitting on a large cash chunk, they can gift that to their children. There is no capital gains tax to be paid on cash, but the 7-year rule applies, which means that once they make the gift to their children, and if they die within 7 years, the 7-year rule it means that they have to pay inheritance tax. But the way the 7-year rule works is something like this. So this is time, 7 years. This is 3 years. This is money, 40%. So if somebody dies within the first 3 years, they have to pay tax at 40%. And if somebody then dies after the 3 years, the tax rate goes down, effectively from, say, 30%, 20, 10, and 0 on the 7 years. Very, very important to understand this principle. So when somebody's making a gift, the 7-year clock triggers, and it's vital that people understand the 7-year clock. So it's not the first 3 years are very dangerous, and then it starts to go down. Properties. So if somebody has a business, a trading business, if they make a gift of a trading business, that's usually exempt from inheritance tax because that qualifies for business property relief, which can be at 50% or 100% depending on the type of the asset. But investment properties, or properties or investment properties. So the first one is main residence. When somebody gifts their main residence to their children, there's usually no capital gains tax because it's covered by the main residence relief. However, if there's mortgage, the mortgage can be subjected to stamp duty, And if somebody gifts, which we had a typical case about 2 weeks ago, somebody had gifted their main residence to their children, and continued to live in the property as if nothing had changed. Now, what happens in that case is something called gift with reservation of benefit applies, which means that even if you've gifted the property to your children and it's been more than 7 years, say 10 years, but when the parents pass away, HMRC will treat that property, put that property back into the parents' estate. Very, very important point. A lot of people don't understand this, and I've seen some horrible experiences or horrible events where people have died and they thought they had done some really, really good tax planning, but nothing was effective because they continue to live in the property. So what happens in these situations is parents have to pay some rent, or there are other more better tax planning strategies that can be applied to reduce the main residence from the parents' estate. But these are complex tax planning strategies that we can talk about at a later time. Now, the next one is investment properties. So if somebody gives their investment properties to children to pass on to the next generation, first of all, they have to pay capital gains tax, they have to pay stamp duty, and the 7-year rule applies. Very, very important. So you cannot never ignore the 7-year rule. So I've seen situations where somebody has gifted a property to their children and they die within 2 years. So they have to pay capital gains tax, stamp duty, and inheritance tax. It's a very, very important point to consider. And this can be overcome by some good tax planning. Some people look at the mirror wills. So husband and wife have a mirror will. So if husband dies, everything leaves to the wife. If wife dies, she leaves everything to the husband. For a lot of people, that's a solution. But in my opinion, that's a time bomb, which gets bigger with time. So, for example, if a husband dies and the value of the estate is 5 million, now no tax is payable because everything goes to the wife. So there's an exemption. But when the wife dies, the estate might be worth 8 million and 10 million. So the children have to pay tax on the 10 million, rather not the 5 million, which they could have done before. So mirror wills can be dangerous. You need to think about it very carefully. Some people use trusts. Trusts can be useful, but trusts are not as useful in states where the property values are quite high. Because the trusts, any investment properties that go into a trust more than this 325,000 have to be paid. You have to pay capital inheritance tax at the rate of 20%. It's called a chargeable lifetime transfer. The final part that we look at is partnerships, LLPs. Now, LLPs and partnerships can be a very useful tool for tax planning. If you're done properly, if you've implemented properly, you get all the documentation and the structuring and the legal documentation, everything correct, you can effectively escape inheritance tax. Obviously, the 7-year clock will still apply, but you do it properly, you can escape capital gains tax, you can escape inheritance tax, you can escape stamp duty, you can mitigate income tax. So there's quite a few advantages of using partnerships in a more effective and constructive way. But it requires a lot of structuring. But overall, it's a very important message for people who have large estates, more than £1 million worth. They need to think immediately. They need to think very carefully about inheritance tax planning, because a lot of people think that they will never die, unfortunately, and that's very common among some of the clients that we have. They will never die, but we do see people who pass away and they leave behind children who have many problems, and one of them is to lose 50% or 40% of the estate that the parents left for them. If you have any questions, you can contact us, but on the links that are being provided below, and we shall be happy to help you. Thank you.